So everyone, welcome to the next video. So in this one, we're going to be looking at monetary policies. So what are monetary policies? They refer to the actions undertaken by a nation's central bank to control money supply and achieve macroeconomic goals that promote sustainable economic growth. So the goal that we've just talked about is to keep a steady economy with a 2% inflation target and unemployment below 5%. Now, it's as we know from our first introduction in the first set of videos, it's the central banks that actually drive, um, are the drivers of the economy, and they're the guys that increase interest rates, decrease interest rates, and that's what you call monetary policies. There's a few other parts to it as well, such as their bond system as well, and their asset purchases. But that's all something that we'll get into soon. Um, in terms of policies, there's two main types. There's monetary policies and there's fiscal policies. Fiscal policies, there's going to be a video next for that. But just to differentiate before we get in, fiscal policies is mainly in reference to taxes. And obviously that affects the borrowing and spending of the economy and all the consumers inside the economy. So to truly break down monetary policies, you've got two types. You've got expansionary monetary policies, and then you've got contractionary. So the first one, expansionary. What it is during expansionary monetary policies are inputted into the system during a recession or a slowdown. Expansionary expands the economy, increasing economic activity. So what can you expect during a recession or a slowdown? As we know from the economic cycle, everything is, very slow. They need things to pick up. GDP is very low as well. Unemployment is high. So now, increase in money supply. Money supply is increased to boost borrowing, obviously investment, and then consumer spending. And the way they do this is mainly through interest rates, which they keep close to 0%. Now, in terms of contractionary, it's a time of very high inflation. So this is post all of the recession and the slowdown, and it's when the economy is starting to get back to how it was. There's too much inflation because money supply is M2 money supply is very high in the economy. There's a lot of spending going on, lots of loans, too much business activity, and of course, as a result of this, inflation increases. Now, contractionary policies, it slows the growth of the economy and reduces economic activity. So what you can expect, I put so less employment, there's higher unemployment, businesses aren't as active as before. So of course you can expect less people to actually have jobs at the time. Contractionary times is usually the time where not many people are spending, not many people are investing. And this is where you've got to start thinking of the risk on and risk off environment. What happens during expansionary? What happens during contractionary? So in contractionary, higher interest rates promote people to keep their cash and store it in the banks because they gain an interest on that. So imagine if you have £100,000 and the bank is offering you, let's just say 2% on that a year. Now it might seem low, but compared to how risky the market is at the moment, this is probably your best bet. Hence why people usually are encouraged to keep cash in there with themselves and of course money in the banks. It prevents spending in the economy, and loans are not as attractive as before because there's too much interest to be paid. So in what ways are monetary policies sort of active? So the first one is in buying and selling treasury bonds through the open market operations. So that increases money supplied by the Fed, purchasing treasuries from securities dealers. So the way that works is we're going to get into bonds very soon as well. But as a precursor to that, the way that the Fed actually controls their bond purchases is they go to securities dealers, they're called, and it's the open market. So it could be you, it could be loads of other investors around the world, and the Fed actually purchases the bonds from them so that they would repay that loan in the future, and that's how they increase money supply through treasury bonds. The second way is through setting interest rates or the discount rate. Now, banks with good credit ratings pay an overnight loan called the discount rate. Banks with worse reputations borrow at higher rates. So to explain this further, as as banks, as the central bank increase, or the Fed increases or decreases interest rates, this has an effect on the so-called discount rate. Now, what that is banks, they lend money to each other overnight because they've got to keep certain reserves in their banks, and certain, like the Fed, for example, they would give banks with better credit ratings a cheaper discount rate, it's called, and then other ones would have higher rates. So this is the second way in which monetary policies work. The third way is through establishing reserve requirements. So basically, it's telling banks what requirement of money they must have on hand for customers. For example, this could be 10%, and obviously it fluctuates from time to time. The rest of the 90% of the money is traded and loaned to other banks through the district Federal Reserve banks. So that's just the, you can say, the local, reserve bank, the way in which they transfer money bank to bank. So of course, if you went to a bank and you had £1 million in the bank and everyone at that day wanted to, withdraw all of their money, the banks have to have a certain amount of money actually live with them, and the Fed actually controls how much they have to keep in the bank at the time. So the amount of money, the amount of bank reserves affects the short-term interest rates because of the amount they loan out or borrow from FRBs, which we just said, District Federal Reserve Banks, to maintain their reserve requirements set by the Fed. As a result, reserve levels affect the interest rate banks charge customers, which influences the entire country's willingness to spend, obviously influencing inflation. Now, this might be a bit difficult to grasp at first, hence why I always recommend to do some further reading on this. But essentially, it's just in three simple ways. They buy bonds. Second way is they set interest rates. And the third way is they establish reserve requirements for the banks. Because one thing you must understand, and I'm not sure if many of you know this, but that banks actually loan money from themselves to another bank, and of course, vice versa. They usually, the Fed actually wants this to happen because they want more banks to be trading with each other rather than getting their money from the reserve itself, so from the Fed. And of course, this keeps economic stimulation between them all, and of course, the economy can flow as it should. But anyways, guys, always refer back to this. Monetary policies is perhaps one of the most important things in macroeconomic fundamentals that you must understand. So yeah, we're going to be getting more in detail into the bond market, especially the reserve requirements that we called. It's linked to something called the Fed's fund rate, which we're going to be getting into soon as well. But anyways, guys, take care and I'll see you in the next video.